IFRS 16 lease. An entity may be in need to use an asset. Assets you can say like machine, equipment or any other asset. They need to use the asset, but at the same time they do not want to purchase it outright. So in that case what they can do is they can enter into a contract with the owner of the asset to make use of that asset for a particular period of time, and in return they can pay some consideration for using the asset. This is usually a lease contract. Now we will see how IFRS 16 defines a lease contract. As per IFRS 16, a lease is a contract or part of a contract between two parties, that is lessor and the lessee. The contract provides a right to use an underlying asset for a period of time, which is usually a lease term, in exchange for some consideration. This is a definition for lease contract given in IFRS 16. Okay, it is a contract or part of a contract between two parties, lessor and lessee. The contract provides a right to use an underlying asset for a period of time, that is lease term, in exchange for some consideration. Now we said there are two parties. Now between two parties there is a contract, lessor and the lessee. Who is the lessor? Lessor is the entity that owns the asset, and they convey the right to use that underlying asset to the lessee for a particular period of time, and in return they are receiving some consideration from the lessee. The next one, who is the lessee? Lessee is the entity that obtains a right to use the underlying asset, and in exchange they are transferring some consideration to the lessor for using the asset over a lease term. So basically here there are two parties, lessor and the lessee. Lessor owns the asset and he gives the right to use the asset to the lessee, and he is receiving some consideration. Same way, lessee is in need of the asset. He obtains the right to use the asset, and in return he is paying some consideration to the lessor. But here in IFRS 16 they are giving clear guidance to say that when a contract is a lease contract. The reason is only if the contract is a lease contract, a lessee has to apply the accounting treatment specified in IFRS 16. Otherwise, no need to apply that accounting treatment. So, for a contract to be a lease contract, the first condition is there should be an underlying asset, and this asset is identified in the contract. Okay. There should be an underlying asset, and this asset is identified in the contract. This is the first point. Second point is the lessee should be given a right to control the use of the identified asset for a period of time, which is usually lease term. In exchange, he transfers some consideration. That is the second point. The lessee should be given a right to control the use of the asset. Okay, here what they mean by the term lessee should be given a right to control the use of the identified asset is lessee should get almost all the economic benefits by using the asset. That is the meaning. Lessee should have the right to use the asset means he should get almost all the economic benefits from that particular identified asset, because he has the right to direct the identified asset's use. Only if these conditions are there, then we can say the contract is a lease contract. Okay, and not only that, there are some more points given in IFRS 16. When there is a lease contract, the lessor may impose certain restrictions on the use of the identified asset in the lease contract, and these restrictions will also be included in the lease contract. Just because a lessor is imposing certain restrictions, it doesn't mean that it prevents a lessee from directing the use of the asset. Even though there are restrictions, still lessee will have a right to direct the use of the asset. These restrictions only defines the scope of the lessee's right of use. See, they are giving examples, restrictions, when we say what type of restrictions the lessor can impose. Let us say, suppose the asset is a vehicle. Lessor may impose restrictions on the maximum mileage the vehicle can be used. And second, suppose the asset is a ship. Lessor may impose restrictions on the materials that should not be carried by the ship. So these are the restrictions. These restrictions only will define the scope of the lessee's right of use. It will not prevent the lessee from directing the use of the asset. That is a point. So what we understand is there can be some restrictions imposed by the lessor which is included in the contract. Still, lessee will have a right to direct the use of the asset. Okay, another point is, and one more thing we can say that before we go to the other point, lessor may impose these restrictions mainly to safeguard the interest of the lessor and the lessee. Okay, yeah, next point. See, the contract is not a lease contract when, suppose in the contract, lessor has the right to substitute the asset with an alternative asset. Then they are telling the contract is not a lease contract. Lessor has the right to substitute the underlying asset with an alternative asset, and by doing this, lessor is economically benefited. So he is doing it. In that case, they are telling the contract is not a lease contract. The reason is because lessee has no right to use the identified asset, because asset will be changed by the lessor anytime. So they are saying that lessee has no right to use the identified asset. So as such, the contract is not a lease contract. Okay, so we have to know all these points, and there are scenarios to understand this these conditions better. So finally, for a contract to be a lease contract as per 16, first one, that should be an underlying asset which is identified in the contract. Second point, the lessee should be given a right to control the use of that identified asset. That means he is almost getting all the economic benefits by directing the use of the underlying asset. Third one, lessor may impose certain conditions. These conditions only defines the scope of the lessee's right of use. It won't prevent the lessee from directing the use of the asset. Last point, if lessor has the right to substitute the asset with an alternative asset and lessor is economically benefited by doing so, the contract will not be a lease contract, because lessee has no direct to use the underlying asset, because they couldn't identify any asset. The asset can be changed anytime. Okay, we have to know all these points. Now we will see the scenarios related to this. And before we see the scenario, because lessee gets the right to direct the use of the asset, that leased asset is known as right of use asset. See, right of use asset. Leased asset is known as right of use asset. This is the lessee's right to use an underlying asset over the lease term. Now we will see the scenarios. See, first one, test your understanding. 1. Coffee bean. Coffee bean enters into a contract with an airport operator to use some space in the airport to sell its goods from portable kiosk for a 3-year period. Coffee bean owns a portable kiosk. The contract stipulates the amount of space and states that space may be located at any one of the several departure areas within the airport. The airport operator can change the location of the space allocated to Coffee Bean at any time during the period of use, and the cost that the airport operator would incur to do this would be minimal. There are many areas in the airport that are suitable for the portable kiosk. Does the contract contain a lease? Okay, first one. You should not start answering to the question directly. First, you have to write IFRS 16, general guidance, whatever given to say a contract is a lease contract or not. Okay, first, what is the point given in IFRS 16? They say that there should be an underlying asset identified in the contract. Second one, lessee should be given a right to direct the use of that identified asset, and return he pays some consideration. What they mean by the right to direct the use of the asset is lessee should get substantially all the economic benefits from the use of the asset. Okay, these are the points to say a contract is a lease contract. First of all, here, can we identify any underlying asset in the contract? The contract stipulates the amount of space and states that the space may be located at any of the several departure areas within the airport. So they don't specify any particular area where Coffee Bean can operate their portable kiosk to sell their goods. So he can give the space anywhere in the departure area, and he has a right to do so, and he's doing it with minimal cost. So we can say we couldn't identify any underlying asset in the contract. The asset is basically here the space, and this is located at any of the departure areas. Okay, so no particular space. So what you can say, and this is done by the airport operator, and it must be beneficial for him. Economically, it will benefit him. You can say that he has a right to substitute the asset with an alternative asset. That is another point we have seen. No, the contract is not a lease contract. If lessor has the right to substitute the asset with an alternative use, and it would be economically beneficial to do so. It appears like that because he could substitute the space with any other space within the departure area. So considering all this, we can say that we could identify an underlying asset in the contract. So this contract is not a lease contract. Mainly we could identify an asset, and lessor has the right to substitute the asset with an alternative asset. So the presentation of answer is write the general points in IFRS 16 to say a contract is a lease contract. What are the points? Mention them, relate it to the scenario, and if you know the conclusion, you can write it or you can leave it. No need to conclude it. Here we could identify easily that there is no underlying asset. So you can say that the contract is not a lease contract. See, second scenario. We have seen one more point. No, lessor has the right to impose restrictions on the use of the asset, and these restrictions will be included in the contract. Just because the restrictions are there, it doesn't mean that it prevents a lessee from directing the use of the asset. It only defines the scope of lessee's right of use. Okay, for that this scenario. Second one. AFG enters into a contract with Splash, the supplier, to use a specified ship for a 5-year period. Splash has no substitution rights. See, Splash is a lessor, no? Because he is a supplier. He has no substitution rights. During the contract period, AFG decides what cargo will be transported, when the ship will sail, and to which ports it will sail. However, there are some restrictions specified in the contract. Those restrictions prevent AFG from carrying hazardous materials as cargo or from sailing the ship into waters where piracy is a risk. Splash operates and maintains the ship and is responsible for the safe passage of the cargo on board the ship. AFG is prohibited from hiring another operator for the ship and from operating the ship itself during the term of the contract. Required. Does the contract contain a lease? Again, to answer, you could just write the general points given in IFRS 16 to say when the contract is a lease contract. Again, they told one of the points given is lessee is imposing certain restrictions on the use of the asset. Yeah, here you can mention, after writing general points, the underlying asset is identified in the contract, which is the ship, and lessee has the right to direct the use of the ship. Is given. They decide what cargo will be transported, when the ship will sail, and to which ports it will sail. So they have fully the right over the use of the ship. But some restrictions are specified in the contract by the lessor. What are they? So these restrictions prevent the lessee from carrying any hazardous materials, and also it prevents the ship from sailing into waters where piracy is a risk. So these risks do not prevent the lessee from directing the use of the asset. Okay. So the terms and conditions in the contract meets the requirements given in IFRS 16. So the contract is a lease contract. Okay. Because only if the contract is a lease contract, lessee has to follow the accounting treatment given in IFRS 16. The accounting treatment for the lease contract in the books of lessees, lessee should recognize a lease liability as well as lease asset in the books. So for that, first we have to make sure that the contract is a lease contract. Okay. So that's all the points for the contract is a lease contract or not. The accounting treatment we will see.